We're half an hour away from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Annabelle Drewlers with David Ingles.
Good morning. A pleasure to have you all join us this morning as we count down to the reopen of mainland markets today. We have a lot to get through as we approach the open today. There's, of course, this big peace deal in Gaza and Israel, number one. Number two is this reopen. We talked about that. Number three is this big, massive privatization conversation on the Hang Seng Bank. We'll get to all of that in a moment. Markets are bid. We're up 0.3 of 1%. Taiwan and AI story continues to be one that we're tracking as well. And TSMC, we're up about 2% in the opening minutes. We've heard overnight out of Jensen Huang talking about the conversations around AI. There we'll get a better indication of that as far as the sales numbers and the export numbers out of Taiwan later on today. Flip the page, please, if we can. Dollar strength, euro slipping back below your 50-day moving average. We are on track for the second worst week on the Japanese currency going back 9 years or so. So we started things off at 147. We're now pushing. In fact, at one point, we were at 153 on dollar yen going into this morning. Gold futures are coming off as well, silver as well, although, of course, 4,000 is the handle there still. Okay, let's have a look, please, at the approach to the open today. A50 futures are coming online, 0.25% to the upside. We are also getting a bit of catch up here. And there's a separate story to be unpacked as it pertains to all the catch up trades onshore, whether that's gold miners, copper, and everything in between. We are getting the initial quote out of the CGB market after being shut for a few days. We're now looking at a 1.87% handle.
Yeah, this has been a really major development this morning. So HSBC is proposing to privatize Hang Seng Bank. Joining us exclusively now is the HSBC CEO, Georges Elhedery. And Georges, it's such a pleasure to have you in studio this morning. We want to know about the rationale for this deal. How long have you been working on it, and what's the reason behind it?
Well, thank you, Annabelle and David, for having me this morning. This is an investment for growth. This is an investment in Hong Kong, one of our home markets and one of our key markets. Hang Seng is an iconic bank in Hong Kong. It's a leading local bank. It has a fantastic customer franchise, have a very strong financial position. It has a cultural distinctiveness. And the idea here is to effectively take private Hang Seng by retaining its distinctive customer franchise, by retaining its branch network, its own customer proposition, obviously its iconic brand in Hong Kong, and its heritage and culture more than or around 100 years in Hong Kong.
The bank already owned a majority of this unit before the transactions. I'm curious, what does this transaction now enable you to do that perhaps you were not in as good a position before the transaction came through?
So, David, a couple of things. First, it allows us to enhance all the capabilities of Hang Seng. So we will be able, as I said, it's an investment for growth. We will be able to offer existing customers of Hang Seng, as well as all new customers of Hang Seng, a wider range of products empowered by the HSBC product suite, such as capital markets for the corporate customers, or such as wealth products for the retail customers. It allows us also to give access to Hang Seng customers, to our international network in a way that they wouldn't have access before. It allows us to enhance all these capabilities by scaling investments in technology, scaling investment in product manufacturing, scaling investment in innovation. That's one. And the other one, it allows better alignment between HSBC and Hang Seng. This alignment will allow us to drive a number of synergies and other efficiencies, which we expect to achieve over time.
Did bad debt play any part in the thinking behind this decision? Because a few weeks ago we were reporting here at Bloomberg about how HSBC had been asking Hang Seng to clean up some of its bad debt, and we were hearing that Hang Seng as well was in the process of divesting some of its portfolios. So was that part of the rationale as well?
So, Annabelle, this has nothing to do with the, bad debt situation. It's very much an investment for growth. This is a medium to long-term investment for HSBC in what is a fantastic brand in Hong Kong, in the market, Hong Kong itself, in a market where growth has been very strong. It demonstrates through this significant investment, it demonstrates our commitment to the economy of Hong Kong. It demonstrates our conviction in the future outlook of Hong Kong. And it demonstrates the appetite we have to continue enhancing the capabilities of Hang Seng for the medium to long term.
Just to ask, that's an interesting point you made there, Georges, on you want to retain the Hang Seng Bank identity. So just to ask you, there's no merger of so the Hang Seng Bank unit will remain as is. In other words, Hang Seng Bank clients will remain Hang Seng Bank clients, and they won't be folded under HSBC.
That's absolutely correct. So what happens is this is a take private. This is not a takeover. Right?
Okay.
In the take private, you retain the Hang Seng brand. You retain the Hang Seng authorized entity under the Hong Kong Banking Ordinance as a licensed bank. You retain its customer proposition, covering as a leading local bank, covering retail customers and commercial banking customers in Hong Kong. You retain its governance, its board, and obviously for customers, the day-to-day doesn't change. The increased capabilities will come over time, and they will benefit from it.
You have made some changes recently to the top leadership at Hang Seng as well, but do you plan any further reshuffles there or any sort of headcount reductions?
So in terms of leadership, this obviously will be a matter for the Hang Seng board and the incoming CEO to decide, but we have a strong leadership in Hang Seng that's been throughout, and as you know, HSBC, Hang Seng is part of the HSBC family. HSBC has been very actively engaged with Hang Seng throughout the last 60 years. With regards headcount, our plan is to continue invest in people in Hong Kong. We want to continue to invest in people, and we want to continue to invest in technology in Hong Kong. We believe this privatization proposal will give our colleagues, specifically our colleagues across Hang Seng, further opportunities for career development, further opportunities for training, and further ability to give talent opportunities within Hong Kong and outside Hong Kong. That's really the essence of what it means for our colleagues in Hang Seng.
From an HSBC shareholder perspective, this is quite a large cash consideration. I think it's over 100 billion Hong Kong dollars. That use of the capital, does that in any way handicap other capital commitments the bank has made? Just help us understand how that works out from a capital ratio perspective, and if that affects in any way the buybacks that you've promised.
Yeah. So, David, the consideration is around 100 billion Hong Kong dollar, which is around just shy of $14 billion US dollars for the minority that we do not hold in the $37 billion you just quoted earlier. We have set ourselves at HSBC since February this year criteria for which we consider acquisitions. These are high threshold criteria. The criteria basically involve, number one, that any acquisition is fully aligned to strategy. Number two, that any acquisition provides a scale or additional capabilities. Number three, that any acquisition does not distract us from organic growth, i.e. the integration is going to be relatively straightforward and easy and does not distract us from organic growth. And number four, that it is more value generative than share buybacks. We believe this acquisition fully meets these four criteria, and this is why we've also announced that we will be not initiating any further share buybacks for approximately 3 quarters, which is a period that we estimate, alongside other actions such as our own capital generation, will allow us to come back to our target operating range of 14 to 14.5 at HSBC.
On the regulatory side, is this something that needed approval from Hong Kong regulators? Were there any discussions either with Hong Kong regulators or with the Chinese government as well? Did they need to be informed of this decision beforehand?
Yeah, as you would expect, Annabelle, we have been in active conversation and engagement with our regulators, both obviously in Hong Kong, but in the UK as well. They've been fully informed. They've been extremely cooperative and supportive, and we wouldn't have issued what we published this morning without the full engagement and the support of our regulators.
You've put an offer out of 30% over the last close of Hang Seng, and clearly that's a sign of confidence that this is good enough for shareholders. What risks do you see that this one doesn't go through?
So, David, I think this is a very attractive offer. This is a significant premium, 30%. It values the bank at about 1.8 times price-to-book ratio. This is significantly higher than any of the Hong Kong peers. And when you look at it from a price perspective, it's 30% on yesterday's close. It's more than 42% on analysts' consensus target price for the next 12 months, and it's more than 49% on the last, on the average price for the last 12 months. So it is, by all measures, a very attractive offer.
Are there cost savings involved as far as HSBC is concerned moving forward?
Yeah, I said this is first and foremost an investment for growth. Okay, but there obviously will be alignment opportunities and efficiencies that that we will drive over time. But we expect that any possible cost saves we will drive first over time, and second through either natural attrition or training and redeployment of our own staff, given the growth opportunities in the Hong Kong market.
Right. I need to ask you, have you identified any of those potential synergies?
So, David, you should expect us to have done a lot of groundwork, and we have good ideas.
So, yes.
Yes. So we have good ideas, but obviously, all of this will be contingent on ultimately the key item, which is the minority shareholders voting, which we ask for their support when we come to it sometime around Q2 in 26.
You mentioned that this is not related to the bad debt situation at Hang Seng, but what about HSBC's bad debt as well? And does Hang Seng look to take on any of that?
No, I mean, look, this has nothing to do with the last few quarters where we reported some bad debt relating to the commercial real estate environment. As we did say about this specific sector, we're seeing actually many of the indicators stabilize, and actually a number of the indicators already start to normalize. So we remain very confident in the medium to long term about this sector.
Your message to Hang Seng Bank employees now that naturally might feel somewhat anxious given this deal. What would your message be to employees?
First thing, Hang Seng's always been part of the family of HSBC, and their employees are colleagues of ours, regardless of the structure. Second, this is, as I mentioned earlier, David, this is a significant opportunity for their career development and their, training and skills development, working across and through the HSBC network, both within Hong Kong but also internationally. And third, we still look at Hong Kong as a major growth market. It's a growth opportunity. I mean, we've been 160 years in Hong Kong. This is a home market for HSBC. It's a strong, this significant investment demonstrates commitment, but also conviction in what we think the future of Hong Kong. Hong Kong, major international financial center, is on track to become the world's largest cross-border wealth hub by the end of the decade, is the super connector between mainland China and the rest of the world. The opportunities for growth in Hong Kong are endless. And for all our colleagues, it's fantastic to be in a leadership position, trying to work with our clients through this growth opportunity.
Georges, we appreciate the time to come in and speak with us, given this massive deal. Thank you so much. Let's speak again soon. That was the HSBC CEO, Georges Elhedery, there on this massive transaction that was announced just about an hour back. And in about 5 minutes' time, we'll get an initial reaction, of course, across Hang Seng Bank shares, which I imagine would be somewhat bid today. Let's see what happens with that. We're also watching for shares of HSBC in about 5 minutes or so. If you are one of our Bloomberg clients, you can rewatch that interview we just did on TV Go on your Bloomberg terminals. You can also be part of the conversation, sending us instant messages here on our shows. Check that out on TV Go. And we're counting down to the open of Hong Kong, 15 minutes away. The reopen in mainland market, Shanghai, Shenzhen, and here in Hong Kong. A very good morning to all of you. This is The China Show. Right, welcome back. Just about 3 minutes back, the PBOC midpoint, first one since, first one for the fourth quarter because of the reopen today, and we are looking at an adjustment already in the offshore currency. The fix is bottom of your screen. So breaking news to tell you.
Yeah, breaking news just in the last few minutes. So we've got some announcements from China. They're looking to implement export controls on rare earth items and also ones that are related to tech. China's also going to be reviewing exports for some chips for research and developments, and that's on a case-by-case basis. But we can get to that first story on tightening exports of rare earth items and related tech with our China correspondent Min Lo joining us this morning. So we've sort of seen these restrictions around rare earths before, but what's new now?
Yeah, we don't have a lot of information, but clearly tech and rare earths is the new frontier of this global tech war, right? Especially with the rally that we have seen in the tech sector. We have also seen the rally in the metals sector as well, because these rare earths are needed to build out AI-powered electronics, to build out data centers, and China is increasingly realizing the importance of this and using its dominance to reshape global markets. I mean, case in point, there was the BHP shipments of iron ore that was banned over a price dispute, and this time China is tightening the rules even further for a list of rare earths, meaning foreign companies and individuals will have to apply for export licenses from the Chinese government before exporting them. So it's probably going to disrupt the supply chain situation as well.
Okay, we're reopening today. Among the many things we're tracking are what?
Well, we're obviously looking out for travel data from the Chinese government and the various ministries. We don't have the full data set yet, but we have some preliminary data. So if you pull out the numbers that I've compiled, we have retail sales and catering data in the first half of Golden Week. That's about 3.3% higher, which compared to Labor Day holiday earlier in the year, that's about half of the gains that we saw in Labor Day. So it's considered pretty muted. You look at the passenger trips as well, staggering numbers, 2.4 billion. That is unprecedented number of trips that Chinese state media has been highlighting. But on year, the numbers, you're looking at 6.2% on year, still paling in comparison to the 8% that we got on the Labor Day holiday as well. You flip the board, take a look at the box office numbers. We're looking at upwards of 1.8 billion yuan. Again, compared to 2024, we're falling short there, even despite the additional day of the holiday this year, the 8-day Golden Week versus 7 days last year. And also compared to 2019 to 2021, we're still far below that. One place that is doing really well, though, is the overseas inbound tourism, because you look at private data provided by Ant, they have global tourist payments on Alipay up 40% on year on the first 5 days of Golden Week. Offline shopping by overseas visitors up 200%. And this shows you that the government policy, the visa-free policy, the tax rebates, those have really helped to pay off, have paid off and helped to attract foreign travelers to China.
Just before we get to how markets are going to broadly reopen, we also want to just address, we've got pre-market starting now for Hong Kong, but we're taking a look at Hang Seng Bank in particular, because shares so far, they're rising, but they're still up around 15%. So the offer here is a premium of 30% to the Wednesday close. So you're not trading at that mark just yet. HSBC, you can see there is a little bit under pressure.
Yeah, that might... I mean, the usual case is the gap between the actual move and the offer might have to do with the fact that this is not a fully done deal, of course, to the point that the HSBC CEO just made to us a few minutes ago. This is fully contingent on minority shareholders actually seeing 30% as good value and then taking that deal, of course, there.
Yeah, he did make that point. They'll have that meeting coming up, and he did say from their perspective he still thinks it's very attractive. But Min, let's shift back, because of course we're going to be tracking those stocks in the session today. But broadly, what are we expecting for the reopen?
Yeah, well, if you look at what happened in the U.S. over the past week, the ETFs tracking the CSI 300 was pretty muted. But I think we can check the pre-market numbers now. Hang Seng is probably, from what I can see, up about 0.1%. But there are corners of the Chinese market that was doing really well, right? Especially the mining sector, the rally that we saw up 12-15% over the past week, so there could be a catch-up on mainland markets as well when it comes to the mining stocks. You add to that the latest news about the restrictions, the export controls, it could push up prices even more. And of course, HSBC, you mentioned earlier, you're checking the stock earlier, again, a very high valuation that based on the premium that HSBC is paying for the company.
Yeah, there we go. One of our top stories at Mainland. Thank you so much, giving us a preview of the reopen of mainland markets in just over 7 minutes from now. We'll leave you with a look at HSBC and Hang Seng Bank following this proposal, this offer to take Hang Seng Bank private, 15% to the upside in Hang Seng Bank. We're down about 3 on HSBC. Plenty more ahead. This is Bloomberg.
We're just under 5 minutes away from the restart of trading here. Hong Kong looking to open a little bit in positive territory today. We have seen a strong session overnight for tech stocks generally, so we'll be watching that tech sector in particular. But we're, of course, awaiting the reopen of mainland markets and the direction that trading takes today.
Yeah, I mean, we were looking at likely some declines are either flat open or a muted open, given, of course, on an index level, things haven't really changed on a net basis. Although within the markets itself, you have some sectors that really rallied while the mainland China was shut. So we talked about gold and gold plays, and we talked about SMIC and some of the other plays there as well. Ganfeng Lithium is one to watch. The A shares and, of course, Jiangxi Copper is also, the A shares have rallied substantially, 13%, while the A share market roughly was closed. CATL is a big story because the JP Morgan cut on the price target, and then I think Morgan Stanley was this morning following up on that too.
Yeah, they've cut them down to equal weight price target there of 585 Hong Kong dollars a piece. So, I mean, trading around that roughly right now. Of course, coming back to a big story today, which is the Hang Seng and plans for HSBC to take that bank private.
Boom.
That's a deal valuing Hang Seng Bank at $37 billion. They're proposing a 30% premium to the close price on Wednesday. But you have the open just ahead. This is Bloomberg.
Welcome back. You're watching The China Show, counting down to the reopen of mainland markets today. That's story number one. Story number two is, of course, the peace deal, phase one, Gaza. And, of course, the other one is this HSBC offer to take Hang Seng Bank private. 30% premium. The stock is halfway there.
Yeah, the stock is halfway there, and it's a major deal. We just had a great CEO interview at the top of this hour with Georgia Elhedery from HSBC talking about the rationale for this. They're saying it's nothing to do with the bad debt that we've seen, possibly HSBC pushing Hang Seng to clean up, but he was talking very much about the synergies for this and also their conviction in the market in Hong Kong and the potential here. But let's take a look at how mainland markets are coming online this morning at the open here, because it's that big question. We've got the early data out from Golden Week, and the signals are not really that crash hot. It does seem like, yes, you've got the rally in stocks, but the wealth effect hasn't really translated because, of course, most households in China are tied to the property sector instead. So households did actually remain cautious throughout the period. Spending was restrained. Box office sales missed expectations as well. So today in the session, you're still seeing stocks looking a little bit muted here, but some fractional gains so far. But names like Quaitro Moutai, for instance, is down 0.7%. CATL as well, we were just mentioning before, they've had a couple of downgrades. That is the story for Hong Kong there. Medea, another name to track, again in the red today. But let's take a look at Hong Kong, because we are seeing equities a little bit under pressure so far. Big focus on what's happening in the tech space, because overnight we had an interview Jensen Huang gave to another media outlet, but essentially talking about the outlook and demand around Blackwell. That's their latest infrastructure for AI chips, and he said it's very strong. It's holding up. So you did see that propelling the tech sector higher. Again, Hang Seng Tech not really feeling that same mood in the session today, but that is really the big question. You've seen so much AI hype in China. Does that sort of overcome really the challenges more around the consumer side?
Yeah. Well, that's $1 billion question. Like, I actually
Probably
don't.
more than $1 billion question.
Yes. Oh, well, I mean, if you have a number to what extent this market could be overvalued, that's the $1 billion amount. The other one, of course, is HSBC, Hang Seng Bank, coming up on your screen. So HSBC was down in 3% in the pre-markets. We're now down 5%. We closed at about 110-ish. We're down about 560. And, of course, the big one, oh, there we go. We're now up all the way 30%. Well, okay, 29.24 to be more specific here. HSBC out with an offer to take Hang Seng Bank, its unit, private. They had owned 63%, I believe, roughly, of the bank. The proposal now is to effectively buy out the remaining minority shareholders in a deal that values Hang Seng Bank at 37. The cash... the cash consideration on the part of HSBC is, I think, something around 13 to 14 billion US dollars to take that through the line. And, of course, it will depend on minority shareholders whether or not they think
whether they're going to be
value.
approving this. Yeah. Let's also take a look at what's happening with the rare earth stocks today, because this is a sector to track. Just in the last few minutes, really, we've seen China announcing a decision to implement export controls on rare earth items and related technology. So essentially, foreign organisations and individuals are going to need to obtain dual-use export licenses issued by the ministry before exporting certain items. So you are seeing these stocks here moving to the upside. Some further commentary just coming as well from China, saying that the rare earth control is aimed at defending their national security, and some A shares as well to track today. We can take a look at those and what we're seeing so far for the open.
Wow.
Again, it's really that metal story continuing to play out.
Yeah, Jiangxi Copper's up 10%. The copper
They
story,
just got a tripling of their price target.
Yes, and that was really one of the metals, apart from gold, that Goldman was actually quite positive on, roughly speaking. 10 to 11,000, I believe, was the range. Was the range there for copper prices. So can we call this an everything rally? I mean, we didn't even talk about Bitcoin, which actually has been doing very, very well. There's AI, there's this. Let's bring in Aidan Yao, Senior Investment Strategist for Asia at Amundi Investment Institute. What's the risk to this rally? No one can tell us that what they're watching out for. Everything seems to be doing well.
I think it comes down to fundamentals insofar as the U.S. is concerned.
Okay.
I think the U.S. market is very sanguine. If you look at earnings expectation over the next 12 months, it's a 13% earning growth expectation. First half of this year, we recorded 10-11%. So the U.S. equity market is essentially discounting a reacceleration of the economy, and that's at odds with our expectation of sub-trend economic growth in 2026. The other one is inflation. If inflation surprises to the upside, that could cut short of the easing cycle by the Fed. The market is very optimistic in its easing expectations.
Yeah.
So if you have this stagflationary phenomena playing out more, that is not being discounted by both equities and bonds, I think that could be an upside for the market.
How important then is the upcoming earnings season?
Very much so. I think given how lopsided the expectations have become, given how lofty valuations have become, I think investors are laser focused on earnings to try to see if earnings is really catching up to the valuations, so make PE multiples more reasonable, or that the PE multiples being discounted are way ahead of the curve. So we have seen, first half of this year, Q1, Q2 earnings seasons were really squarely forecast by investors, and they have delivered, to be honest. But as I said, I think the future earnings projection looks pretty optimistic. So I think they are going to look at the Q3 earnings to see either a proof to their expectation or disproof to their expectation. And in terms of structure of S&P, it's also important. I think Max 7 and the other 493 are very different. Max 7, people are concerned about, some people are concerned about whether the large capex spending is going to deliver the desired returns. And the other 493 is truly reflecting the real economy. And I think people are looking for either the earning reports as well as guidance to see any signs of the impact of tariffs or policy uncertainties coming through. So I think people are going to focus on the earnings season.
How would you advise people to play AI now?
That's a very good question. I think there's been growing debate in the market about whether AI, its current valuations are sustainable. Now, we are cautious about the U.S. equities over the medium to long term, and the high valuations of hyperscalers. It's a part of that caution. Now, don't get me wrong. We think AI is a revolutionary technology. It's going to change the world. It's going to change the way in which we live our lives. So the technology itself is for real. What we are concerned about is up until very recently, Max 7 has been the only AI game in town. So huge amount of capital moving into these stocks significantly jack up their valuations. And we have seen also quite a significant capex spending effectively over the past 12 to 24 months. And as I said, there's a concern about whether they will truly deliver the returns that are currently being discounted by the market. So on the one hand, we are okay with the macro technology. On the other hand, we're worried about the micro way in which investors are playing the systematic. So our recommendation is to build a more balanced and diversified AI portfolio. Max 7 is no longer the only AI game in town anymore, right?
Yeah.
US is no longer monopolizing AI development. Given the rise of DeepSeek, given the larger language model coming out of China, I think there's a pretty vibrant AI ecosystem here competing head-to-head with the US hyperscalers. And Chinese names are actually more reasonably priced. They are also developing AI using slightly different approach and strategy. The US ones are going for the holy grail of generative AI, AGI, whereas the Chinese ones are more pragmatic. They have a smaller, more affordable models targeting the task at hand. So by adding some Chinese names to a Max 7 portfolio, you actually achieve a genuine diversification. And I think that increases portfolio resiliency against the potential downside surprises.
Okay. You're talking about the Chinese platform names there, the ones that are developing these types of models. But what about other parts of the AI story in China, more on the sort of infrastructure side or component side?
Sure. I think there are a lot of opportunities in both A and H. I think, if we look at the mega tech companies, Alibaba, Tencent, Alibaba's on the cloud side, Tencent is sort of on the application software side. We also have some sort of hardware infrastructure AI players listed onshore in Asia as well. So I think there's plenty of opportunities in the China ecosystem to fish.
Yeah, who would have thought a barbell strategy within AI makes sense within that trade? Can I ask you about gold?
Sure.
What, in your view, what is gold as an asset? What is that? Is that a structural trade? Is that a tactical trade? Is it a risk-free? Is it a risk asset? Like what is it?
What is it? Well, let's break down the gold market. So from a market technical perspective, the momentum is pretty strong. It reached 4,000 for the first time ever. I think, if you look at the price actions, it's basically going vertical over the last couple of weeks. So I think that momentum will draw more inflows into the market and potentially pushing market even higher. If you look at the valuation of gold, now valuation of gold is
how do you measure valuation of gold?
Exactly. So I'm getting to that. Yeah. So it's very difficult to value gold because it doesn't create cash flow. So you can't calculate the equivalent equity PEs. But what you can do is look at the gold prices relative to other economic and market variables depending on the user case of gold. If you see gold as a currency, you can look at the gold prices relative to world and to world debt levels. If you see gold as a standalone asset class, you can compare gold performance vis-a-vis global equity, vis-a-vis global bonds. If you see gold as an industrial metal, because it does have some industrial use, you can look at the gold relative to nominal GDP of the world. If you calculate all these ratios, you see that these ratios have been pushing higher across the board over the last couple of years, simply because of the very rapid appreciation of gold prices. Yeah. But these ratios are substantially below the absolute peak in the late 1970s and the early 80s. So even though US dollar nominal prices have reached a record high, these so-called valuations of gold are still way below the record peak. Finally, if you look at fundamentals, cyclically speaking, gold tends to perform in an environment of falling interest rate and falling dollar, which typically occur when the Fed is in the cutting cycle, which we are in right now. I would argue that the cyclical support for gold has been absolutely supercharged in the last couple of years by structural forces. There's been structural demand for gold because the world has been plagued by record debt, which put a downward pressure on fiat currency, and gold is seen as an alternative to fiat. The world has also been experiencing rising geopolitical tensions, which have been pushing a lot of central banks to swap soft safe haven assets to hard assets. We have also seen an erosion of confidence in the current global monetary arrangement centered on the dollar and the U.S. Treasury. And maybe just finally on positioning, we know that central banks has been accumulating gold reserves. Yeah. Gold is right now about 25% of average central bank reserve. Now, that number is substantially below the 60s and 70s before the fall of Bretton Woods. And people would also argue that recently we have seen a lot of ETF inflows into the gold market. If you look at ETF for gold, it's a fraction, less than 2% of U.S. Treasury and U.S. equity. So small change of that rotation could make a big difference. And finally, global fund managers only hold about 2.3% of their portfolio in gold. 41% of managers don't actually hold any gold at all. So if you believe in Ray Dalio saying 15% should be in gold, or Jeffrey Gundlach saying 20-25%, this is significant room to build in that gold allocation. So whether you look at the positioning, technical, valuation, and fundamental, I think there's plenty of reason for gold to push higher. We are overall structurally positive on gold. We think it deserves a higher weight in the portfolio in a new normal environment. Yeah. But gold has performed really well so far this year, right? It's going parabolic. Yeah. So that type of performance cannot last. Even something is in the secular bull market, don't expect that kind of a price action to last. So do expect some volatilities and short-term corrections.
But that thought of the private sector also getting involved is exactly what was underpinning the upside case from Goldman Sachs yesterday, because they've raised their year-end target for next year to 4,900, and they're saying it could go even higher if the private sector gets involved. But that was really great insights, those insights there. That was Aidan Yao, a senior investment strategist for Asia at Amundi Investment Institute. And coming up in the next hour, Stan Chart is going to be joining us to weigh in on whether China's growth can stabilise by year-end and how aggressively the PBOC might cut rates. Plus, what is next for the Yuan? We'll have plenty more ahead. This is Bloomberg.
You wouldn't have even thought of it. They came together. The world has come together around this deal. You know, having the ability to deal with trade, having the ability to use tariffs to help me make a point. The tariffs have brought peace to the world.
That was President Trump there speaking to Fox News about the latest Israel-Hamas peace plan, and he earlier touted the deal on his Truth Social account, saying all hostages will be released very soon and Israel will withdraw its troops to an agreed-upon line. Joining us now is Mona Yacoubian, Director and Senior Advisor of the Middle East Program at CSIS. And Mona, thanks very much for making the time for us. I do want to start with the overall scope of the deal, and also to get your insights into how significant of a breakthrough this is.
I mean, it's an extraordinary breakthrough, given 2 years of devastating conflict, trauma in both societies, widespread destruction in Gaza and humanitarian suffering. The deal promises an end to the war, a release of all the hostages, prisoner releases, the flowing in large scale of humanitarian assistance into Gaza. This is a moment that the region, and really I'd say the world, has been waiting for.
Mona, David here. So this is phase one. What do you think should be in phase two?
Well, there are elements that are prescribed for phase two. I think what's key, and this is where there could well be snags, is the disarming of Hamas. The plan calls for the demilitarization of Gaza, the destruction of all the military terror infrastructure, so the tunnels, etc. That's going to be an extraordinary lift. No clear indicators of how that is actually to be done. It also calls for phased withdrawal. So the first withdrawal is the one that's initiated in this first phase to an agreed upon line. But then there are subsequent withdrawals, and how and when those withdrawals take place is open to question. And then, of course, the plan, as it's envisioned, appears to have a buffer zone within Gaza in which Israelis would maintain a troop presence. That appears to be counter to how Hamas is describing it, which is that it would be Israel's complete withdrawal from the territory. So big questions remain there on disarming versus withdrawal. And also, are we indeed seeing the final and permanent end to this conflict? Or are there openings for the conflict to resume as differences begin to emerge as to whether or not Hamas is being disarmed and so forth?
Yeah, there's certainly a number of complex elements of the proposal. Another one as well is also agreeing on the roster of Palestinian protesters or prisoners, rather, that should be released. That could also end up being protracted. So what's also, you mentioned the sticking points from, or the potential hiccups from the Israeli side. What about from the Palestinian side as well, or for the Palestinian side?
Well, again, questions about whose names have been approved. I'm assuming, I'm not privy to the internal negotiations, that there are agreed upon lists of names of Palestinian prisoners, prisoners with life sentences and others to be released. But there is also a question because the agreement ties the release of prisoners to the return of the remains of deceased hostages. And that apparently is far more complex than it may seem, unfortunately. I mean, these are remains that will need to be exhumed, that are probably deep down under the ground in some of these tunnels. So will they be able to find the remains, get them out, et cetera? I think those are all questions that are still going to be open. And then, of course, there are these much bigger questions about the so-called day after. If all of these hurdles are crossed, how will governance and security arrangements be maintained in Gaza? And here, too, the plan is very ambitious, and it's not clear that it will be able to get to what is envisioned by the plan. An international stabilization force, for example, comprised of Arab and other countries. That's a pretty tall order, to say the least. And then, of course, the questions around governance. And here again, no Palestinian Authority, of course, no Hamas, and there I think Hamas is acquiesced. But what does this Palestinian Executive Committee that is designated in the agreement, who's it comprised of? And of course, we have this overarching role, at least again, as envisioned by the agreement, played by President Trump as the chairman of the so-called Board of Peace and former British Prime Minister Tony Blair. These are big questions, and how they actually work on the ground, especially in such a complex environment, I think those are some very significant challenges that lie ahead.
Well, in your view, Mona, just as a final question, who do you think, or which group do you think is best positioned to govern the Gaza Strip, and who pays for the rebuilding of Gaza?
Well, in terms of who governs, I mean, I think by all accounts, it's going to be essential to have a Palestinian element of governance. I mean, it's to have them governed by external outside authorities, I think, is not going to work. And so what does this committee look like? There's talk about a reformed Palestinian Authority. What does that mean? How do they get there? Those are critical questions. But in order for this, for there to be lasting peace in Gaza, there has to be Palestinians governing Gaza. That is a critical element that has driven the conflict. Who pays for reconstruction? Here, I think many are looking to the Gulf countries to invest in rebuilding Gaza. But I can tell you this, they will not put a cent into Gaza if they feel that this conflict has not been resolved in a final way. They are not going to invest in order only to see things get blown up again.
Mona, thank you so much for taking the time. Mona Yacoubian, their Director and Senior Advisor of the Middle East Program at the CSIS. Plenty more ahead here on The China Show.
Greg Tanner, I want to read.
Right, just for a look at, I think there's a big deal in town. There we go. 7% down on HSBC, down the most in about 6 months. Hang Seng Bank is up nearly 30%. This go private offer or take private offer out of HSBC really playing out across these markets. Very quickly, they reopened in Mainland China. It's the other top story we have across these markets today with some of the catch-up trades. Jiangxi Copper, the gold place, Ganfeng Lithium. There we go. All substantially up in the first 25 minutes of the session. We'll have more on the way here on the China Show. We'll have a look at what's happening in the currency markets, specifically with the euro also pushing below some key technical levels, and dollar yen also headed, bumped its head on 153 yesterday. Plenty more ahead. This is the China Show.
Welcome back to the China Show, taking a look at the Shanghai there, but also how markets are faring because we've got mainland stocks reopening after an 8-day Golden Week holiday, and we are seeing them moving a little bit to the upside. It's been a very interesting period because we have seen the data coming in a little bit softer than expected, but it's also the other question. We've had so much optimism around the tech story in China, and does that AI narrative continue to hold up? Yeah,
it's more than offsetting, I guess, the lack of quick progress on the underlying data, right? We're getting so far a mixed bag on the high frequency numbers from the holidays. We talked about box office yesterday, but we talked about Macau as well. 8-day holiday. Okay, I need an 8-day holiday. I need an 8-month holiday, really, if you think about it. What a year 2025 has been. Okay, let's have a look at, so that's the cash markets. Change the page, please. So we're looking at offshore, onshore currency. Do we have the onshore currency there? Because that's the one that's, of course, trading today for the first time as well. I'm told it's okay. No, we'll show you that in some way later on as well. There's a quirk that has to do with the long holiday. But in any case, of course, 10 and 30-year yield on your screens for you. We're now at 185. We're down about 2-3 basis points on the 10-year yield. Let's bring in our FX reporter, Iris Ouyang, here with us to help us understand the FX and rates markets and what you're looking at, Iris, going into this reopening today.
Thank you, David and Annabelle. So the bond and yuan traders are looking at the economic data from China's 8-day Golden Week holiday. You know, some of the metrics like property sales, retail and catering sales, and also some consumption data are key indicators of domestic demand and the consumer sentiment. And especially in the
you can look at me, Iris. It's okay. I'm not going to bite.
Yeah, especially in the FX markets, people are also discussing the yuan fixing. It's stronger than expected, stronger than the average estimate in a Bloomberg survey. So we are seeing the CNH, the offshore yuan, maintain some of the gains this morning. And in the bond markets, people are watching the stock market's moves because the stock market is still front and center for the bond investors. As we have seen so far this year, the stock market rallies have been pressuring the bond yields.
Yeah, exactly. It's that rotation we're seeing bonds to equities. So then what is the highest conviction in the bond market right now?
So the bond investors are expecting authorities will work to prevent massive sell-offs or redemptions in the bond markets. They are having strong faith in the PBOC, especially that it will prevent there will be more sell-offs. And they are expecting the Ministry of Finance will demand, the yields will be low enough for them to sell more of those notes.
All right, that was Bloomberg's Iris Ouyang there. Thanks for joining us. And let's get more on the reopen now of Chinese markets coming back from the Golden Week holiday. Joining us is Becky Liu, head of China macro strategy at Standard Chartered Bank. And Becky, we were just talking there about that rotation we're seeing from bonds to equities. But what's the biggest theme that you're seeing right now?
We are clearly seeing a decoupling between market sentiment, performance versus the economic fundamentals. So starting from July, we started to see people become very bullish on onshore equity. When we were in China, everyone we talked to were bullish equity. So that has been leading to a very substantial rotation out of the bond market into the equity market. And we believe this trend will likely to continue for the time being. Like given the from evaluations point of view or from even a regulatory point of view, that they are, for example, having the insurance company that have to put at least 30% of newly received premiums into stock investments from here on. So that's why like all these changes are really reflecting a regrading of China's medium to long-term outlook. So that's leading to a complete ignorance of the short-term weakness in economic data. So that's why in the short term we believe market will continue to be driven by sentiment instead of fundamental.
Are you seeing any change in inflation expectations in China? Are you also seeing that somewhat reflecting this re-rating that's taking place, or have we not seen any progress on that front?
Inflation, or more precisely deflation at this stage, will likely to continue for some time. So if we look at the broad forecast across either our in-house or market consensus, no one is really expecting a sustainable rebound of the PPI inflation back to the positive territory before 2027. So some people indeed expect the headline to move towards zero or slightly above zero in the short term because of the commodity prices, etc.
That's right.
But no one is really expecting a sustainable move at this stage. So people are relatively downbeat when it comes to the effectiveness of the anti-involution this time around, or people call it supply side reform 2.0. It was extremely effective a decade ago, and people still have that memory, and market was trying to catch that kind of impact from the market performance point of view. But fundamentally, the entire situation, fundamental, or where they are planning to put the efforts are completely different. So from our perspective, we believe PPI inflation will stay negative. CPI inflation will likely to stay very low, but it will likely to move back to the positive territory and stay there at a low low level, probably somewhere between 0 and 1% for some time.
Yeah, it's interesting because we had the stronger industrial profits numbers, and everyone was talking about the anti-involution drive starting to take effect. If you're talking then about people or investors looking at the medium to longer term expectations of economic recovery, when does that actually happen? What's your thinking around that?
I think it's about, like, people no longer feel that China is going to collapse anytime soon.
Right, okay.
Like, it clearly outperformed people's expectation on the back of the higher tariff. So, like, even if you look at the export number so far this year, it's very, very strong. It's up nearly 6% for the first 8 months of this year versus an average of 0% for the last 2 years. So exports has been very strong, and also people start to realize that the Chinese tech and the US technology gap has been narrowing, and that's also reflecting in the equity market performance as well. So that's why it's not necessarily that people are looking for an immediate economic recovery. I think market consensus is quite downbeat for the second half of this year and in 2026. For example, we are now still looking for GDP decelerating from 5.3% in first half to 4.5% in the second half, and especially in Q4, probably it will be just above 4%, which is relatively low. And in 2026, we find that we think 4.5% could even be challenging. So these are short-term, like, people still consider these to be short-term situations, and so long it's not falling even faster and steeper from the current level, it appear to be that investors are comfortable with that and still will probably still try to bring back some of the previous underweight position in China exposure.
The other component to this rally is not so much expectations of a recovery, but liquidity. And do you think the liquidity situation remains the same, if not improves, going into next year? And your outlook for rates, open market operations, everything in between there?
We think liquidity is going to stay accommodative, and structurally they have put together a number of new tools. For example, the new 14-day reverse repo, which will be bidding on the price with a fixed quantity. So all these tools will facilitate a continued accommodative and relatively stable interbank liquidity condition in China from here on. And also market, like, if we look at the pricing of, say, IRS or cash bonds, they are completely priced out future rate cuts already. While we look at the economic fundamentals, look at the credit data, fundamentals are still very strongly calling for additional rate cuts from here, yet the central bank is very reluctant. So getting into the fourth quarter of this year, we still do not rule out the possibility for the PBOC to be cutting rates by another 10 bips. And at the same time, we also believe that it's time for them to start purchase CGBs from the open market again.
I wanted to ask about that. What does that look like exactly? What sort of quantity are you expecting?
So if we look at the past year's experience, during August and December, during the time that they were buying, they bought 40% of net issuance from the central government during that period of time. This time around, given Q4 supply is massively lower, that on one hand, it's negative from the growth perspective because that's a primary source of fiscal income and fiscal stimulus. For example, if you look at the first 3 quarters of this year, supplies were up by more than 60%. In the fourth quarter, if no additional quota is given, it will be down from a year ago. Even if they bring forward next year's 1 trillion swap bond issuance, it's going to be flat versus a quarter ago. So it's less necessary from a supply-demand dynamics perspective that PBOC need to buy a lot more. So the only trigger that they will need to buy a lot more would be coming from a bigger sell-off on the back of the bond to equity rotation, which is possible in our view. So for the moment, we are still looking for a similar amount of purchase like last year, but we believe that's going to be a moving target.
Do you think there's a target on the yield that would catalyze them to act? In other words, some people have told us it's 2%. They're not going to allow the yield to top 2%. What is that level to you?
I believe it's more about the pace of change or the momentum in the bond market. Currently, if we see equity market continue to rally, then the back end of the bond yield curve, like 10 to 30-year part of the curve, will likely to still under further pressure. But technically, there's also an improvement because all the ultra long-dated special government bonds will be concluded on the 10th of October, which is this week. So from here on, there's no long-dated bond issuance anymore. So that's why PBOC probably would be watching on the move, the pace of the move. And from our perspective, if 10-year is approaching 190, no need to get to 2%. It would already be a very good level for the PBOC to start buying. Even without that getting there, they could still be buying bonds at the front end of the curve. At the end of the day, they have been letting their holding maturing since the beginning of this year. So PBOC, purely from a CGB buy-sales perspective, it has been conducting QT instead of QE.
So on balance, supply is the primary consideration on the long end. On the short end, to your point, there's some buying there. On net-net, does the bear steepening continue or does that reverse?
In the immediate future, it looks like the bear steepening could last for a bit longer. But for the entire fourth quarter, we believe it will likely to reverse. Because in the short term, we have a number of events. We have the fourth plenum, and we have this potential, say, reported major breakthrough of the U.S.-China trade negotiation. And if you look at today's fixing, it's exceptionally strong. Like based on our model calculation, like no matter how you set the parameter, it's impossible to get to such a low fixing. So all these could be good gestures, just feeding into the ongoing negotiation. So if that's the case, we could see equity market momentum holding up, and that will continue to impact the back end of the curve. We're much more comfortable with the very front end of the curve, given they have already priced out all the rate cut expectations.
You mentioned the currency. What's your expectations around downside, upside potential?
If we talk about dollar CNY, the downside for the time being is 710. Clearly, PBOC doesn't want to set the fixing below 710, and we haven't seen spot trading below fixing since 2017. So from a spot perspective, it looks like it will be very difficult to break through 720 as well, even if we got a further rebound in dollar. As what we are seeing over the holiday period, dollar rebounded by 1%, but fixing has completely discounted the dollar move. So we will likely to see dollar CNY staying range bound somewhere between 710 to 720 for the time being.
So just very quickly, you mentioned the word gesture. That's interesting. Do you think politics will play a part in how the fixing trends the next 2-3 weeks?
I think the only role it's going to play is that it will prevent the CNY from depreciating very quickly. But it doesn't mean that they are willing to have more strengthening at this stage. So 710 would probably still be at the floor.
There we go. That's why we have you here in the show, is that nuance is important. Thank you so much. Becky there, Head of Macro Strategy for China at Standard Chartered Bank. Right, still in focus, we're shifting our focus rather to Bloomberg Screentime underway on the West Coast in LA. This panel is a conversation with the LA Mayor, Corporate Sarah McGregor, Bloomberg News National Desk Managing Editor.
Yeah, great event that's happening in Los Angeles, and it's a really great lineup coming as well, because we've got the Netflix co-CEO, and we've also got Jimmy Kimmel that's going to be speaking with us later on this hour. So we'll bring those conversations to you. We'll have more ahead. This is Bloomberg. You're watching The China Show, and this has been really one of the top stories today. HSBC issuing a filing this morning with plans to privatize Hang Seng Bank at a $37 billion valuation. So shares the offer here is to buy shares at a huge premium to the Wednesday close. It's 37%, and you're trading around that mark right now. Yeah, in fact, the CEO was kind enough to carve out some of his time to cross the street and speak with us earlier on. HSBC CEO says the decision to privatize Hang Seng Bank is about growth. It's a vote of confidence when it comes to Hong Kong. He told us exclusively that the move has nothing to do with the unit's more than $3 billion of bad debts. Have a look.
This is an investment for growth. This is an investment in Hong Kong, one of our home markets and one of our key markets. Hang Seng is an iconic brand in Hong Kong. It's a leading local bank. It has a fantastic customer franchise, have a very strong financial position. It has a cultural distinctiveness. And the idea here is to effectively take private Hang Seng by retaining its distinctive customer franchise, by retaining its branch network, its own customer proposition, and obviously its iconic brand in Hong Kong and its heritage and culture more than around 100 years in Hong Kong. The bank already owned a majority of this unit before the transactions. I'm curious, what does this transaction now enable you to do that perhaps you were not in as good a position before the transaction came through? So, David, a couple of things. First, it allows us to enhance all the capabilities of Hang Seng. So we will be able, as I said, it's an investment for growth. We will be able to offer existing customers of Hang Seng, as well as all new customers of Hang Seng, a wider range of products empowered by the HSBC product suite, such as capital markets for the corporate customers, or such as wealth products for the retail customers. It allows us also to give access to Hang Seng customers, to our international network in a way that they wouldn't have access before. It allows us to enhance all these capabilities by scaling investments in technology, scaling investment in product manufacturing, scaling investment in innovation. That's one. And the other one, it allows better alignment between HSBC and Hang Seng. This alignment will allow us to drive a number of synergies and other efficiencies, which we expect to achieve over time. Did bad debt play any part in the thinking behind this decision? Because a few weeks ago we were reporting here at Bloomberg about how HSBC had been asking Hang Seng to clean up some of its bad debt, and we were hearing that Hang Seng as well was in the process of divesting some of its portfolios. So was that part of the rationale as well? So, Annabelle, this has nothing to do with the bad debt situation. It's very much an investment for growth. This is a medium to long-term investment for HSBC in what is a fantastic brand in Hong Kong, in the market, Hong Kong itself, in a market where growth has been very strong. It demonstrates through this significant investment, it demonstrates our commitment to the economy of Hong Kong. It demonstrates our conviction in the future outlook of Hong Kong. And it demonstrates the appetite we have to continue enhancing the capabilities of Hang Seng for the medium to long term. That's an interesting point you made there, Georges, on you want to retain the Hang Seng Bank identity. So just to ask you, there's no merger of the Hang Seng Bank
unit will remain as is. In other words, Hang Seng Bank clients will remain Hang Seng Bank clients, and they won't be folded under HSBC.
That's absolutely correct. So what happens is this is a take private. This is not a takeover. Right?
Okay.
In the take private, you retain the Hang Seng brand. You retain the Hang Seng authorized entity under the Hong Kong Banking Ordinance as a licensed bank. You retain its customer proposition, covering as a leading local bank, covering retail customers and commercial banking customers in Hong Kong. You retain its governance, its board, and obviously for customers, the day-to-day doesn't change. The increased capabilities will come over time, and they will benefit from it.
You have made some changes recently to the top leadership at Hang Seng as well, but do you plan any further reshuffles there or any sort of headcount reductions?
So in terms of leadership, this obviously will be a matter for the Hang Seng board and the incoming CEO to decide, but we have a strong leadership in Hang Seng that's been throughout, and as you know, HSBC, Hang Seng is part of the HSBC family. HSBC has been very actively engaged with Hang Seng throughout the last 60 years. With regards headcount, our plan is to continue invest in people in Hong Kong. We want to continue to invest in people, and we want to continue to invest in technology in Hong Kong. We believe this privatization proposal will give our colleagues, specifically our colleagues across Hang Seng, further opportunities for career development, further opportunities for training, and further ability to give talent opportunities within Hong Kong and outside Hong Kong.
That was the HSBC CEO there, Elhedery, speaking exclusively to us earlier on the China Show. And if you're a subscriber and you want to rewatch that interview, you can via our interactive TV function, TV Go. You can also become part of the conversation by sending us instant messages, so do check it out at TV Go. We'll have plenty more ahead. This is Bloomberg. China is tightening the export of rare earth technologies, broadening restrictions that have been a source of tension with Washington. So let's get more with our China economy and government editor, Alan Wong. So, Alan, we've seen restrictions in the past, but what's new about these? And also, how much do we want to read in the timing of this announcement as well?
Yeah, so it wasn't that long ago, back in April, when they first put restrictions on the exports of 7 types of rare earths that later caused some supply chain disruption globally, because these rare earths are used in the manufacturing of a wide range of equipment and tools, including electric vehicles, but also for weapon systems. So now they have broadened what types of rare earths applications, tools, and technologies that needs an export license from the Chinese government before Chinese companies could send them abroad. But the announcement today is two-part. One is that the more of technologies related to rare earths, such as smelting, mining, and recycling of rare earths, they're now under export control. And the other part of the announcement today is about how overseas companies that process rare earths from China or make equipment that has rare earth minerals in there, before they could export that stuff forward, they need a license with Beijing. So this is another layer of application and license approval process that may further the kind of disruption that we saw back in April.
Yeah, I mean, will this net affect the success rate of the upcoming talks? Or I think when you look at what Beijing has said about rare earths, a lot of it is operational, and we need to put more details into that just to have a better, clearer conversation around rare earths.
Yeah, so in the announcements today, China made clear that it wants to maintain supply chain stability, which is a tacit way to say that any eligible and proper use of rare earths will still export. But then if you want to use Chinese rare earths for military purposes and other applications that China doesn't approve of, we're not going to grant those kind of applications. So that's signal that civilian use of rare earths will be approved. But then there comes a question of the bureaucracy part of it, and if there's going to be any delay just because of the process of approval that we have seen in the last couple of months. And it's not just with the US and China. It's also other countries, such as the European Union countries, that have been complaining about delays in getting rare earths. So we'll see potentially global impact from this change.
Okay, there we go. The latest on the rare earth story. Alan Wong there, China Economy and Government editor. We're just headed into the Tokyo lunch break. We'll give you a wrap of the markets there, plus other things moving across Asia Pacific today.
It's 11:29 a.m. in Tokyo, and Japanese markets are just about to go into their lunch break. We are seeing a strong session here. You've got the Nikkei really among the big gainers today, up 1.4%. It has been, of course, a bullish few days, and investors are really rethinking the possibilities for the markets with incoming leader Takaichi as well for sentiment. And you're continuing to watch there the Japanese yen, because that weakening trend is extending here down past that 152 level.
Yeah, in fact, I think overnight, I don't know the specific time of the day, but I think we did get to a 153 handle on. I'm not sure if there's transactions that actually went through or simply quotes, but that's just to say it's really weakened quite a bit. I think we're on track now for the second worst week on the Japanese currency going back 9 years, right? So the move has been quite something. We'll need to see more, of course, before we worry about intervention based on some market commentary.
And there's another stock we're watching in particular because, of course, one of the big heavyweights on the benchmark is SoftBank, and you're seeing shares climbing here today in the session. There has been a plan. It was actually announced just going into the market close yesterday for Tokyo trading hours, but they announced a plan to acquire the Swiss conglomerate, essentially ABB's robotics unit, or their industrial robotics unit. And so that has really boosted expectations for profit growth linked to AI. So this is a deal that's worth $5.4 billion, but it is just the latest we've seen in a string of AI bets for the company this year. So SoftBank shares are climbing here to the upside. Another sort of SoftBank-linked news today as well has been the announcement that Graphcore, which is a chip designer that's based in the UK but fully owned by SoftBank, they're also making a £1 billion, or they're expected to make a £1 billion investment in India, and that should be coming next week, that announcement. But chips generally is a big focus in the session today because there's quite a few different headlines that we're trying to get our heads around here. But one of the first ones is that we had
Which one?
Well, I think we can probably start it. The sentiment was overall bullish in the session on Wall Street, and that does follow some question marks over the circular nature of some of the deals that have been announced, because yesterday or this week we've seen OpenAI and AMD, that investment. We've seen NVIDIA looking to invest in XAI, that's Elon Musk's AI startup as well, AMD or rather NVIDIA and OpenAI as well. That circular nature has been a big question. But Jensen Huang did an interview actually on CNBC, but talking about demand for Blackwell, the Blackwell architecture, or that series, the most advanced AI chips on the market, saying it's really high. So that is something that investors seem to have listened to. Yeah, and to the point you just made there, right, on the demand for Blackwell, for example, I think we will get a somewhat decent tangible indication of that later today, because TSMC actually, fittingly enough, in about, what time is it now? So in about 3 hours from now, actually, I think is scheduled to release the monthly sales number. So that's a very good benchmark for this specific industry to track. And on top of that, I think export numbers out of Taiwan more broadly, trade numbers are actually coming out as well later today. Just one last thing to note, just on more headlines coming through. This one just actually dropping. Ant Group releasing this Ling 1T AI model. That's all we know so far about that. And when we get more details on that, I promise you we will get them to you. Okay. We will set the chips conversation aside. We'll take you straight back now to LA, where Bloomberg Screentime is underway. And let's listen in to this ongoing panel with Greg Peters, the co-CEO of Netflix.
Vulnerability where you start to breed, complacency, arrogance, and things like that. And I think in the world that we live in, entertainment, this is the most competitive entertainment environment that's ever existed in the planet, in the history of humankind. It's getting more and more competitive, and if you don't maintain the sense that you are constantly vulnerable, I think you will lose.
So I think the biggest thing that people point to as perhaps a sign of vulnerability, at least that I notice, is that your engagement, the amount of time people spend on the service, has been pretty flat over the last couple of years. And then you look at the regular drops from Nielsen, and you see that streaming share of TV time has gone up quite a bit, and your share that's gone up is a pretty small fraction of that. A lot of the growth has gone to these free services. So how do you address that?
Well, I think you just essentially explained it, right? Which is that we moved to on-demand very early on in the process, so we sort of got the benefit, or basically built our business around that benefit, and then everyone over a period of time caught up, and essentially from our perspective, they're all now moving to that model and moving to that benefit for consumers. So, frankly, the fact that we were actually keeping pace in that sort of shifting tide, if you will, I think is a reasonably good thing. It's not great, I
mean, good thing, but from everything I've heard inside the company, like the goal was basically to replace television, right? Like have Netflix be the one, if you can watch basically anything on television on Netflix except for news and until recently sports.
Well, I think expressing that as an ambition, and also that as a way to organize how the company thinks about what we're trying to go do, is great. I also think that that's not consistent with saying that we thought it was realistic that we were going to be the only thing that people were going to watch, right? Because I also don't think that that's realistic at the end of the day. So I think there's always going to be like multiple sources of entertainment, even in the categories that we serve. We want to be, we want to win as much of that as we possibly can. So I'm back to being complacent. I'm not happy with the fact, that we're not growing engagement. We should grow more engagement. I think we will. I expect that you'll see engagement numbers will go up for us. But also, I don't think there's a world in which we be the only thing that people watch.
A big project I assume to help grow engagement was the new user interface, UI, that you rolled out over the last year plus.
Yep.
Can you point to some key ways in which that has already helped, or you think it will help?
Well, I would say a lot of what we've been doing is essentially re-architecting the entire stack. This is from sort of how algorithms get calculated. We used to calculate overnight everyone's recommendations. When they show up in the morning, we would have that baked. Now we do it dynamically on the fly. And now we've created a UI where essentially you can, connect those algorithmic pipes in and also launch new modules.
Can you use words that I'm not even going to insult the audience here, that I will understand?
Sure. Yeah. So thank you. Basically, what happens now is that when we think about what titles do you want to watch, right? We used to do that overnight, and you'd show up and we'd give you those titles.
Right.
But now the way that we do it essentially is, as you're navigating the UI, we think about, what are signals that you're giving?
I skipped over this thing really quickly. I'm not interested in that.
That's right. That's right. So I think that's something that's going to take us, I think, a while to really build the fullness of how that delivers, benefit for our users. But the thing that I can point to right now that the new UI structure is designed to go do and is doing for us is serving new content needs. As we expand beyond just film and series, we expand to live events, and the UI has to do a different job, which is like, why do you want to show up at Thursday at 7 p.m.? Because, you're going to watch a boxing match that, you wouldn't otherwise get to see. Or why do you want to play a game? Or those kind of things. That's what it's doing for us right now.
Right. When it comes to live, that was something that you sort of famously said you weren't going to do sports for a while. And I know it's not just sports. You also do other live events. But the sports have been the biggest, right? Your NFL game was really big. Boxing match was huge. Or both boxing matches. The Logan or the Jake Paul one will decide if it's really a boxing match or Elhedery.
You can offer your own opinion. I'll refrain.
But how much more are you going to invest in live events over the next few years? And are there things that you know that you want to add to the service that you don't have right now?
So I would say start with, live we think of as an important additional form of entertainment that we can deliver members. It's sort of a different style of entertainment, where actually it's interesting because in contrast to our on-demand service, which has tremendous benefit because you control the entertainment when you want to watch it, the big benefit of live is that we're all experiencing the same thing at the same time, and that has tremendous sort of social and conversational relevance, right? So we want to do more of it. It represents a very small fraction of our total investment. It represents a small fraction of our total hours, but we think it also does a different job, so it's sort of...
Does it have a different impact? Do you see, because from the third-party data I've seen, you tend to see huge surges in signups around some of those bigger events.
Yeah, I think we expect that it will do the same work ultimately that our other content does, which basically is a reason to sign up and a reason to stay. That's, at the end of the day. Now, I think back to your point about like, what do we know we want to get and stuff like that, we're still really learning in this space. So we're really trying to figure out like, okay, how is this delivering value to members? How is this delivering value to the business? And there's definitely different phenomena, which these are punctuated moments, to your point, right? Which, people go like, okay, if I'm maybe on the edge of signing up for Netflix, this might be the thing that pushes me over, to actually do that. So I think we'll see different things for sure, but we really are learning as we go. I
want to throw one poll to the audience before I ask the next question, because they are related. If we get it up there, I will ask. So I promised Greg I would do this. Keep in mind how much these sports cost. Football is the most expensive, tennis is the least expensive, everything else sort of fits in between there. So even though Greg and I both like tennis, it's probably smallest audience, but also least expensive.
Big international audience.
What would you say are the odds that you make a bid for one of the football packages when the NFL opts out of its current deal in 29?
It doesn't really fit with our strategy as we understand it right now. So again, back to your point, we think about what we're doing as an events strategy. And it turns out, as you said, sports are big events, right? And so we can plug those into that strategy. But we also want to make sure that we're being really, really disciplined about, are we investing in ways that are profitable for the business? And some of the big league sports things, we don't actually have a way to figure out that math.
Soccer.
Okay, all right. Well.
Although isn't the sort of the magic of football? I get that the NFL is maybe tricky for you and that it's not global and how expensive it is, but the reason it's so successful, it's the one sport where like every Sunday sort of is an event.
It's amazing in that regard, right? But I think to some degree that lack of substitutability is, of course, what gives the rights holders the leverage, and they've done a pretty good job at getting paid.
I know you have. I can tell that you guys have this vision of where like you have more leverage than the sports leagues in a negotiation, and that has basically never happened in media.
That's right. So until it happens, I would say you should have some skepticism about that.
Okay. One other thing that you guys have basically never done is large-scale M&A. But the bigger you get, the more you tend to get tied to different companies, different deals. There's been some reports around you guys being interested in Warner Brothers Discovery. Is there any truth to that?
I'd say this, we come from a deep heritage of being builders rather than buyers. I also think that it's, one should have a reasonable amount of skepticism around big media mergers. They don't have an amazing track record over, the history of time. So, I would say it's our responsibility to evaluate all our options and try.
So you'll have a conversation, but the odds of an offer are pretty low.
Yeah, our job is to figure out like what's the best way to grow our business, right? And then we have to think, really carefully, like how do we invest, our capital, our time, and our attention? And if that's the best way to do it, great. And if it's not, then we should do something else.
One area you're investing a lot of capital right now, or you might quibble with a lot, but it is gaming.
Small fraction of our total investment, but yes. I appreciate you saying that.
You've been offering video games for 4 years. What grade would?
A little over 3.
Little over 3. Yeah, sorry. What grade would you give your gaming efforts so far?
I'll give us a B-. How's that?
Okay.
I would say, look, you want maybe just start where we're at, right? It's a big market. $140 billion ex China, ex Russia. That's just consumer spend. That doesn't include ads. So we think it's a real opportunity for us to try and earn a percentage of that over a period of time. A lot of what we've been doing is really just building the foundation, right? We've been doing a lot of real hard plumbing work, but now we're getting to a really interesting place where we're going to deliver more of what our vision of what we should be doing in the space is. And we call it games because that's a rubric or, a name that we all can relate to. But really, I would look at this as how do we add more interactive capability? So that means even things like taking our live program, back to the live program, how do we add interactivity with live? So we got voting right now that we're in testing on with David Chang and his live cooking show. You'll see that those interactive features come up with Star Search when we do another live event, a non-sports live event of Star Search. So that's an exciting place to be. And then it gets also...
This is the Dave Chang.
This is the Dave... Yeah, so you can see this is sort of how the Dave Chang experience is working. And, again, this is, the tip of the iceberg, and we'll get deeper into this as we go. We're also, I think, more clear around what are the gaming areas, back to the more traditional gaming areas that we are operating in. it's a lot of interactive games around our IP. So you think about what we did with Squid Game. I don't know if you saw Thronglets based on the Black Mirror universe, but it's worth checking out because if you're a Black Mirror fan, it's so in universe. And the fans of Black Mirror just loved it because it was like they were having a meta experience there too. But even like Happy Gilmore, we did a golf game with Happy Gilmore that got a remarkable amount of consumption. So,
do most of the people who use Netflix know you offer games?
I would say, that's part of, frankly, what's been hard about this. And I think it's hard for any brand that has a deep consumer sense of what are you doing for me, right? And then you're like, well, I'm going to do this as well. And it takes a while to really build up that sense of what's happening. But it's not that dissimilar to, let's say when we launched, in a new country, like I
you went to Japan,
right? Yeah. So when we started in Japan, 2% of the Japanese population had ever heard of Netflix. So nobody knew nobody even knew our name, much less be able to tell you what we were doing. And we were doing pay TV service in a country that doesn't really have a great pay TV operation. We're doing over the internet in a way that was totally new. And so you got to every day build a little bit of like, what are we doing, who we are, what are we, how are we here to serve you? So that 10-year journey, let's say, we just did the 10th anniversary in Japan. Tremendous progress over 10 years, but it took us a long time. And I think, the gaming situation is not dissimilar to that.
How much is it an impediment that, for the most part, now you can only play it on your phone?
Well, I would say, the phone is. What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games, a pack of social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game, we've got Tetris, we've got like a Mafia style whodunit. This is me and our CTO Elizabeth playing Boggle here, which is we're two very competitive people, so it got pretty ugly.
Who won?
A little bit. I'm not going to say.
That means you lost.
Oh, does it? Why don't you watch the video, my friend? you triggered my competitive spirit. But this is, so it's your phone, which is an incredible device, and there's all sorts of things that you're going to be able to do on your phone that you can't do on a normal controller, like touch screen, and this is us basically picking our words on that. And it's dead simple to use. It's intuitive. And then this is, us on the earliest days of how we actually can use that. And if we, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Good. So you made a comment earlier about how it's never been more competitive in media. How worried are you about competition from the second richest person in the world?
Well, I guess I'm not sure that that's exactly who's competing with us. That's maybe a good question. Well, look, start with, it's fun to have some new vigor in the competitive ecosystem and the dynamic there. I think it's exciting. It sort of, keeps everybody on their toes, and we're trying to figure out, everyone's trying to figure out, okay, what does that mean and what does it do? I also think you have to go back to, it doesn't change the business fundamentals, right? You still have a bunch of problems to go solve and a business to grow, and so we'll see what happens.
So you bid against them for UFC, they come way over the top, that doesn't worry you, that doesn't send a signal that maybe they'll be able to spend somewhat irrationally for...
Because we are constantly dealing with a situation where our competitors outbid us, and what I try to remember with our team is we should bid up to the point where we think it's going to deliver value back to the business, and if somebody outbids us, I say you should applaud and say go with God and try and monetize the heck out of that.
Is it fair to say that YouTube is the stiffest competition, or at least for attention?
Sorry, say that again?
YouTube.
Oh, YouTube, yeah, for sure they're a competitor, of course, yeah.
But would you say they're the toughest for you?
They're a formidable competitor for sure. And I think because to some degree they compete in a and a different access. I think it's orthogonal competition is always the hardest competition to deal with because it's hard to measure how you're doing things. They have angles against you that you might not be familiar with, and so I think we're developing an understanding of what's our place in the ecosystem relative to them.
Yeah.
How do we basically shore that up? We want to be the place where we invest ahead with.
So what is that? Do you look at that and say, we need to do UGC? Do you look at that and say we should skim off their biggest talent?
I think the dumbest move would be to try and match them in every way, because I think you have to really know what lane you're operating in and then try and be excellent at that and then defend that lane. And so what do? We invest ahead with creators so that they can tell their stories in really, really compelling ways in a way that the YouTube model doesn't really allow them to go do. So we want to work with the best creators on the planet. Some of those folks are going to come from YouTube. They're going to come from TikTok. They're going to come from traditional places all over the place. We want to be the place that they want to go when they're ready to tell that story at that level. And then our job is to find the biggest global audience for them and make that really, a strong, reinforced loop.
Yeah. I was talking with your old friend Robert earlier, and he made a parallel of sorts that I think other people have done between sort of the dawn of UGC and where we're at with AI entertainment right now. A lot of people over the last week in Hollywood very alarmed about Sora, new product from OpenAI. Netflix, it seems like, has been slightly less reactionary than some of its peers, if I'm being fair. You guys have talked openly about using AI on at least one project. So why disclose that, and how are you using AI in terms of the creative process, not tech, product, any of that?
So I think a better parallel in my mind is actually the internet rather than UGC.
Sure.
So that's how I think about it generally. Maybe just to start with, we've been in the AI business for people that haven't tracked for 2 decades.
Yeah.
And so we think of that heritage, our tech DNA, large sets of data, scaled consumer products, scaled business processes, including on the content production side, as being the reason that we actually have an advantage to lean into how we use these technologies. We want to do so in a disciplined way, though, because I think you can throw a lot of stuff around that's not really going to matter, and we want to figure out where are the places that deliver value to the business. Consumer experience is one. Advertising is another big one. You mentioned content production. We feel like our job is to give our creators a suite of tools that we've vetted and that are work together, orchestrate together well. They can use other tools too. That's up to them to figure out what they want to go do. But we see a lot happening in previs and shot planning, and scheduling and pro forma budgeting and all that stuff. We see a lot happen in the sort of post side of things, the VFX, and you mentioned examples that we've used before. That's a pretty good example where we've been able to do shots that we wouldn't able to do in other ways. And so we see that continue to proliferate, and we'll let the creators lead the way in that process. But I think our job is to assist them in that rather than hold back.
So I'm curious, because some of your peers in Hollywood have sued some of the AI companies. Do you feel confident that an OpenAI, a Google, a Meta, or some of the smaller ones like Midjourney have violated copyrights that you guys own?
Well, I think we're in this process where you're going to see a lot of people trying stuff, but I would say we have a very strong position that IP should be protected. We believe in supporting creators; they should tell amazing stories with us, with other people, and that output should be protected. And so we believe strongly that tool creators, some of the folks that you mentioned, and also consumers, we have sort of a legal standard around this, whether it's coming from an AI model or from another human creator. Like if you copy, without AI, we've got a legal standard around that, and we should enforce those standards and be strong about that.
Another area where some of your peers have gotten into conflict that you have thus far avoided, although it flared up a bit recently, is in politics. At a moment where you have a president who kind of has gone after a lot of elite institutions, probably has tweeted nasty things about your company at one point or another, how do you think about, do you have to do anything to proactively defend yourself?
I think we've tried to stay focused on serving members and serving the business as being our overarching organizing principle. And when it comes to some of the things that trip, we've been pretty clear about our position that we are in the business of entertaining the world. That is our mission.
But in entertaining the world, you are invariably going to program certain things that a lot of people don't like, right? That's the danger of
harm. If we are doing our job well, so just to be clear, we're trying to now program for a number of human beings on the planet that's approaching 1 billion people. Those people all do not think the same. They have different views of what their entertainment should be delivering to them. So if we are doing our job right, we're working with a wide diversity of creators and we're supporting their ability to tell their story in their own way. And if we're doing it right, there's something on the service where every one of us as employees or every one of our members probably thinks is not great, or they don't like, or maybe they think is harmful. And frankly, if we don't have that, we're actually not doing our job correctly, right? And so we've been pretty clear that that's the business we're in, and we're going to keep doing that.
But you do every so often take stuff down when governments don't like it. We just haven't had it happen here.
To be very clear, we do not respond to government pressure. When the government has a legal claim that you're legally obliged to respond to, then we react to that. But we then actually post that so that there's transparency around that. And again, that's happened 5 times in the last year, right? So it's not, if you think about the kind of content that we carry and the number of places that we carry, we've generally been successful at having a wide range of content up in every place that we operate.
Okay, we're going to run through a few things quickly because I think we only have a minute plus left. Would you have made more money from K-pop Demon Hunters?
You've been listening there to a screen time conversation between Bloomberg's Lucas Shaw, but also the Netflix co-CEO there, speaking really a very wide-ranging conversation about media mergers, about free speech under Donald Trump, lots of different topics here, but certainly a very big conversation coming up with a late-night TV host, Jimmy Kimmel, just in a few minutes' time. But Dave, that big focus as well, the China market reopened today.
Yeah, before we wrap things up there, something to look ahead to, of course, is that Kimmel conversation is, of course, this coming back of mainland markets, some of the travel-related stocks. I'll leave you, though, with a look at benchmarks, and just to underscore this reopen across mainland markets, we're closing in at 2% now on these gains across the mainland. We will see you all tomorrow. That's it from us here on The China Show. Insight with Elhedery and Jimmy Kimmel is coming up next.